Imagine looking at a split screen. On the left is a standard $100,000 index fund balance. On the right is a deed to a $500,000 property. Most financial gurus tell you that all debt is evil and that slow and steady index fund investing is the only safe path to wealth. But they are teaching you how to protect wealth, not how to build it from scratch. If you are starting without millions, a simple 7% average return on a modest savings rate means you will reach true financial freedom exactly when you are too old to enjoy it. The truly wealthy do not rely on slow, linear growth early on. Instead, they use a tool called asymmetric leverage. I know that sounds incredibly risky, even reckless. So let me earn your trust over the next few minutes by showing you the exact math. To see how this works, let us look at a fair test with two different people. Alex and Ben both are 30 years old, both earn $120,000 a year, and both have exactly $100,000 in savings ready to invest. From here, they choose completely divergent paths. Alex follows traditional, responsible advice. He puts 100% of his money into a low-cost S&P 500 index fund and waits. Ben, however, uses a controlled, structured form of leverage. He uses his $100,000 as a down payment to purchase a $500,000 cash-flowing real estate asset. By using a bank loan, Ben has effectively multiplied his capital efficiency by 5 times. Both started at the exact same finish line, but their wealth is about to move at completely different speeds. The entire concept of leverage hinges on a single mathematical law that most everyday investors completely miss. It is called the spread. Specifically, this is the exact difference between your cost of capital, which is the interest rate you pay the bank to borrow money, and your return on invested capital, or how much profit the asset actually generates. Most people look at these numbers and do some basic subtraction, but they miss the real magic. For example, if you borrow money at a 6% interest rate to buy an asset that makes a 9% return, you might think you are only making a tiny 3% profit. But that is completely wrong. Because you only put down a small fraction of your own money to buy that asset, the return on your actual cash equity is amplified exponentially. You aren't just making 3% on your cash. You are making a massive return because the bank's money is doing the heavy lifting for you. If you do not calculate this spread before you invest, you are totally blind to how real wealth is engineered. To see how this plays out in the real world, we have to look at the first 3 years of this experiment. During this initial phase, Alex, our index fund investor, feels like an absolute genius. The stock market moves up smoothly, gaining a nice, reliable 8% every single year. When Alex logs into his investment account, everything looks perfect. His statement is clean, his balance is rising, and the entire process requires zero effort. He does not have to deal with broken pipes, angry tenants, or confusing contracts. Meanwhile, Ben is having a very different experience. He is busy dealing with expensive closing costs, setting up property management teams, and looking at a paper balance that looks much flatter and slower than Alex's. If you were to look at both of them during these first 36 months, you would think Alex made the smarter move. On the surface, the traditional, no-leverage path looks much safer, cleaner, and more profitable. But this is just a deceptive honeymoon period, and the math is about to shift. By the time we hit year 5, the hidden mechanics of both investment choices finally reveal themselves. Alex's index funds are still growing, but he is now facing a major silent partner that is quietly stealing his wealth: inflation and tax drag. If his money is sitting in a normal taxable account, he has to lose a portion of his gains to taxes every single year. On top of that, his growth is strictly tied to how much extra cash he can afford to save and contribute from his paycheck. His progress remains slow and steady, but completely linear. This is exactly where Ben's leverage advantage takes over. Let us say Ben's property has only grown in value by a very modest 4% each year. To most people, 4% sounds much worse than the stock market's return. but you have to remember the total size of the asset. A 4% gain on a $500,000 property is $20,000 a year. Because Ben only spent $100,000 of his own cash to buy it, that $20,000 profit actually represents a massive 20% annual return on his original investment. To make things even better, Ben does not have to pay down his bank loan with his own salary. His tenants are paying rent every month, which pays down the principal mortgage debt for him and creates brand new equity out of thin air. When we project the numbers out over a 15-year timeline, the split between these two strategies becomes impossible to ignore. Let us look at Alex first. His original $100,000 has been compounding at a solid 8% every year in the stock market. After 15 years of waiting, his account has grown to roughly $317,000. It is a good result, but it required a decade and a half of patience just to triple his money. Now let us look at Ben's leveraged asset. His $500,000 property has been growing at that slow, modest rate of just 4% per year. Yet because of that growth, the total value of the asset is now worth $1,800,000. At the exact same time, his tenants have been paying rent month after month, which steadily chopped away at his bank loan. His original mortgage debt has now shrunk to just $250,000. If you subtract that remaining debt from the new value of the house, Ben's net equity is a staggering $550,000. He now possesses nearly double the total wealth of Alex, even though his actual investment grew at half the speed of the stock market. This is the power of compounding a much larger number right from day one. However, we have to look at the other side of the coin because leverage is always a double-edged sword. It is dangerous to assume that borrowing money is a one-way street to getting rich. Let us look at what happens if the economy hits a rough patch and the market drops by 20%. For Alex, his index funds will drop by 20% on paper, which hurts to look at. But because he owns his shares completely and does not owe anyone any money, he never loses his actual shares. He can simply sit back, hit pause, and wait for the stock market to bounce back. Ben's situation could be completely different depending on the rules of his loan. If Ben used the wrong kind of leverage, he would be in serious trouble. For example, if he borrowed money using a volatile stock market margin account or bought properties that lose money every month, a 20% drop would be a total disaster. The bank would immediately demand their money back, triggering a margin call or a foreclosure. This would force him to sell his assets at the worst possible time, wiping out his savings completely. Borrowing money without fixed, long-term terms is financial suicide. If you do not have a safe loan that cannot be taken away from you when things get tough, you are not investing. You are just playing a very dangerous game with your future. Before you ever touch a single dollar of debt, you must protect yourself by running a simple personal formula. This is called the leverage safety threshold. It is a strict test designed to tell you whether a loan is safe or whether it is going to destroy your finances. To run this test properly, you only need to ask two basic questions about the asset you are planning to buy. First, is the interest rate on the debt completely fixed? If the rate can change or go up down the road, it is far too dangerous to touch. Second, does the asset bring in enough steady cash flow to cover the monthly loan payments, even if things go wrong? You need to assume that bad times will come. Ask yourself if the asset can still pay for its own loan during a 15% vacancy rate or a major market downturn. If the investment cannot easily pay for its own leverage during a crisis, you are not actually investing. Instead, you are just gambling with a ticking time bomb that will eventually explode. To apply this strategy without destroying your financial life, you need a safe roadmap. This is a simple, controlled leverage sequence that protects your capital while letting you grow your wealth. It works in 3 clear steps that take the guesswork out of borrowing money. The first step is to secure a low-cost, fixed-rate loan where the lender cannot suddenly call the loan back. This means using safe options like a primary or investment mortgage, or a low-cost line of credit that is backed securely by your assets. The key here is that the bank cannot force you to pay them back just because the market drops. The second step is to ensure that your asset meets a specific math rule called a 1.25x debt service coverage ratio. In plain terms, this just means that the asset must produce at least 25% more monthly income than the actual debt costs you. This extra cash acts as a safety cushion for repairs or slow months. The third and final step is to take those amplified returns and reinvest them into completely different liquid assets. By moving your extra profits into things like safe index funds, you permanently lock in your wealth and build a balanced portfolio that can survive any economic weather. When you look at the big picture over a 30-year career, the true impact of this strategy becomes crystal clear. The difference between understanding safe leverage and fearing it isn't just a few $1,000s saved here and there. It is the massive difference between finishing your working years with a modest $1.2 million nest egg or building an $8.5 million estate that can take care of your family for generations. Fearing all debt keeps you locked into slow growth, while understanding controlled leverage changes the entire game. If you want to look at your own portfolio and see how different types of fixed loans can safely speed up your timeline, you can use our easy leverage spread calculator. It is waiting for you in our Wealth Vault linked right below this video. It is time to stop playing the wealth game on defense and constantly worrying about small market drops. Switch your focus to smart mathematical execution instead of listening to mainstream hype and guesswork. Thank you for watching, and I will see you in the next video.